Good afternoon and welcome this afternoon to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined by my good friend Cameron May out there in the chat helping to answer those questions for those of you that are here live. For those of you that are here in the recorded version, thanks for being here with us as well. You can leave a comment in the comment section. We'll get back to you as quickly as possible. I get the opportunity today to fill in for Connie Hill, who has been teaching this class for a little while. I taught this class for a long time. My schedule kind of changed up a little bit because of travel needs and a few other things. So it's a good opportunity to come back and see what's going on over in this neck of the woods in this Trading Index Options webcast. So I'm glad to be back here amongst familiar names and faces. So we appreciate you being here with us. A couple of quick housekeeping items that we need to take care of as we get into this discussion today. Remember that everything we talk about simply for illustrative and educational purposes only. It is not a recommendation of a particular security or strategy or anything else. Remember that investing involves risk, including loss of principal. Now, when we talk about trading equity and index options, they carry a high level of risk. They're not suitable for all investors. Make sure the characteristics and risks of standardized options that is something that you want to make sure that you're aware of before you consider any option transaction, index options or otherwise. Also, remember that when trading options at or near expiration, there are some specific risks relative to those types of strategies, including lack of liquidity, significant slippage, width of bid-ask spreads, volatility changes, gamma influences, those types of things. So make sure that you're aware of those as you examine and explore those types of close to expiration types of strategies. Also, one thing that's important to remember, especially when we talk about index options, the majority of the index options that we're going to talk about are what are referred to as European style index options. That means that those options cannot be exercised, the rights that those options entail cannot be exercised prior to expiration, meaning if you are the holder of a long call or a long put, you cannot convert those long calls or those long puts into long stock positions or short stock positions because there is no stock. First of all, it's cash. So you can't convert those options into a cash position or a margin position. But because they're European style, that means on the converse, they can't be assigned early. So if you're short those options, you can't run into the obvious scenario where somebody exercises their right and you end up with an assignment notice prior to expiration. It just doesn't happen in a European style option, but American style options, it does and it can. So just be aware of that as you make sure that you are keeping that in mind in the strategies that you're looking at. Now, we're going to be using the Thinkorswim desktop software platform today, specifically the paper money version of the platform, not a guarantee of future success out there in the real world. Remember that the paper money platform does not do certain things that a live trading account will do. Namely, it doesn't allow for early assignment of options, which we don't have to worry about since we're talking about European style indexes. And it doesn't fill orders at exactly the same price as you would get filled in a live trading environment. The paper money platform is going to fill orders at an algorithmically derived midpoint between the bid and the ask, generally. Sometimes that'll be different, but generally it's an algorithmically derived price. Live trading accounts going to be subject to market forces, and there are a variety of those. So the fill prices may be different on those orders in a live trading account. So as you move your practice from paper trading to live trading, make sure that you're aware of some of those differences. So one of the things I wanted to talk about really quickly here is as we get into this discussion of index options, I just want to talk about the idea of what an index option is and kind of what the characteristics are. Remember that index options, because we're talking about a product, an underlying instrument that has no tangible notional value, if you will, right? So there aren't shares available for an index. You can't buy and sell the index itself because all the index is an accounting of prices of something, an amalgamation of individual stocks, an amalgamation of commodity prices, an amalgamation of individual stocks within an industry. Or an amalgamation of volatility measurements, whatever it might be, that has a cash value assigned to it then. So index options are what are referred to as cash settled options. They don't have a stock component to them, meaning if you were to choose to exercise, if you could exercise your right to buy, let's say you owned a call option, you chose to exercise your right if it was American style, or for at expiration if it was a European style option, you're going to end up with cash in your account or a debit to your account, depending on what has occurred. And so, because they're cash settled, it's one of those things where you don't have positional risk if you were to if you were to take an option, for instance, all the way to expiration. Position risk being, let's say you end up with long shares of stock in an equity option, or you end up with a short position in stock in an equity because of an equity option, and then the underlying stock moves. You don't have that positional risk in an index option. So that's something to pay attention to. One of the reasons why traders may trade index options. Some other reasons are maybe a little bit more esoteric and specific to individual traders and investors' portfolios. Some index options provide differing levels and characteristics of, say, for instance, tax treatments. No, I'm not a tax advisor. Neither is Cameron. So we're not providing tax advice. Consult your own tax advisor about your particular circumstance. But some index options may receive different tax treatment than equity, than just regular stock option contracts. All right, so let's take a look as we jump into this discussion. We're going to pop over here to the Thinkorswim desktop software platform. And by the way, once again, Cameron's out there in the chat to help answer those questions as we get into this discussion. So the first thing I want to talk a little bit about is volatility. And since we're talking about index options, volatility becomes kind of core to the discussion because one of the index options out there, as we get into this discussion, one of those indexes that's out there that we have traded, in fact, before as an example, is the VIX index, the volatility index. So what I have on the screen right now in this display, I do not play one on TV, Ricebird. What we have on the screen right now in this display is the VIX, the volatility index of the S&P 500, as an average applied volatility for those index options versus VIX-EQ, VIX-EQ. I talked a little bit about this the other day when I was talking about long options. The VIX-EQ is the average implied volatility, not for the index S&P 500, but it is the average implied volatility for the constituents of the index. So it's taking all of those individual volatilities for all of those components, and it's weighting them equally. Now, the difference appears, you can see that here's the VIX, and the VIX is currently sitting down here right now. The VIX is at about the 16 half handle or so right now. And we take a look over here at the VIX EQ, and the VIX EQ is up in that 40 or close to, well, almost 50, a little bit higher than 40. We're just about 50, coming off of 50 here. And one of the ideas is that the S&P 500, just by itself, because it is a hedging tool, that index is a hedging tool used by institutions and some retail traders, that volatility level tends to stay somewhat compressed. Because anytime that volatility rises, anytime the VIX rises, anytime that volatility increases significantly, on the S&P 500 index, there tends to be selling activity going on that keeps that implied volatility compressed a little bit. Now, VIX EQ takes all of the implied volatilities of all the constituents, all the individual stocks within the S&P 500, averages them and plots them. That's oftentimes quite a bit higher than the VIX. So let me just draw this out. This is the implied volatility of the VIX. This is VIX right here, VIX, right? This is VIX EQ up here. You can see the difference between those two, right? That's a pretty decent difference in terms of that range. That would suggest, and this oftentimes happens ahead of earnings announcements, is that you get this big disparity between these two. Because individual stocks tend to see increases in implied volatility ahead of earnings announcements. Once that earnings announcement is gone, has passed, that implied volatility tends to fall. So once we get past the meat of implied volatility, increases around earnings, what's likely to happen is this VIX EQ, that implied volatility number is likely to fall. If that implied volatility falls, oftentimes then what happens is, because of arbitrage, VIX may tend to rise. So a high VIX EQ, especially ahead of an earnings announcement, tends to drive the SPX, the S&P 500, higher. Again, greater expectation of movement, greater speculation on upward price movement or downward price movement, whatever the case might be. So when we start seeing these coming back together, start to see VIX EQ falling and VIX rising, or likewise, the opposite direction if they had inverted, where we had that same situation here in March and April, that tends, when you have VIX EQ higher than VIX, that tends to bring the market down a little bit. Alero, this is entirely the dispersion trade, 100%, right? So what we might expect, Bruce, is a short-term spike or a short-term rise in VIX based on that chart divergence, right? This is the dispersion trade that Alero is talking about. So you see that correlation has been trending down. These have been trading almost at an inverse to one another, or moving at almost an inverse to one another, not necessarily trading in that relationship. So why does this matter? Why are we even talking about this? Well, here's the thing. We look back at what we've got on the VIX, and let me pop over here to the volatility index. Let me clear my annotations really quickly. And if we were to just put in the chart here, VIX, the volatility index, you see the volatility is pretty low, right? We're at 15.76. We were at 16 yesterday. So volatility is moving a little bit lower. But notice what's going on here. Notice that volatility is starting to just maybe rise off of those lows. Those lows are just getting a little bit higher here. So it's very possible that we could see a break out of this, what's kind of building symmetrical triangle here, and a possible increase in volatility, maybe back up into that 17, 18 to 20 handle. Now, here's the problem. None of that theory, that dispersion theory, the difference between VIX EQ and VIX itself, takes into account emergent events, geopolitical risk, monetary shocks, Fed announcements, CPI numbers, data points, those types of things can shock the market out of this relationship very quickly. But in many of these cases, that tends to be, you don't typically tend to see the VIX get shocked back to the downside. Not often. Especially not in the low VIX environment. You typically don't tend to see a very low push in the VIX. You do, however, see fairly sharp spikes to the upside as a result of emergent events. So my thought was, in putting this idea together, if we've got those two things going on, we've got the VIX EQ moving down and the VIX moving up a little bit, maybe we think about the idea of taking a trade on the VIX index that would benefit from a rise in implied volatility. Now, I know, here's the thing, I know that we're kind of in the meat of earnings season right now. So a couple of things are going on. That's keeping that VIX EQ relatively elevated, but it also presents the possibility that some company stumbles on earnings and creates that shockwave, that emerging event that causes VIX to rise and spike a little bit. So that was kind of my initial premise in this discussion. So now what I'm going to do, now that we're looking at the VIX, and remember the VIX is, you can't buy the VIX, but it has index options associated with it. So I'm going to go to the trade tab here for those VIX options. And it's important to remember that VIX options are AM settled options, which means in the current state. Now, this may be changing soon, maybe as soon as the end of July. But right now, the way that this works is these options, these AM settled options, stop trading on the night before, at the close of the market, on the day before the expiration. So these 22 July expiration options that are AM settled, you can see as I'm hovering my cursor of this, it says AM settled, and we've had this conversation before. These actually stop trading at the end of market on July 21st, but they settle the next morning. So there's some risk there. Now, Cboe, Chicago Board of Options Exchange, or Cboe Global, is working to try to decrease the amount of overnight event risk associated with some of these AM settled options. And so they're doing some things around that in terms of settlement and exercise, but not yet. We haven't seen exactly how that's going to play itself out quite yet. I'll get Connie to talk a little bit about that once more clarity comes out about that. But here's the thing. It's important to remember that if you hold on to a VIX option or any AM settled option through its expiration, because it stops trading before it settles, there is position risk. The position risk is that overnight, the VIX could explode or could go down significantly. And that could change the price at which the VIX options settle. So you go to bed thinking, wow, cool, everything's fine. Next morning, the VIX opens significantly different, and you're not fine. So just be aware of that. So one of the things that we're going to think about as we trade VIX options is being out of the position prior to that whole settlement conundrum, that whole AM settlement conundrum. So what we're going to look at here in the possibility of seeing a rise in VIX, we could do one of a couple of things. We could go long volatility, which gets really kind of meta, because if you think about it, if we're speculating on VIX rising, but if VIX rises, the individual implied volatility of those VIX options is likely to go down, then it gets all kind of weird and meta about all of that. So what we're going to do is we're going to look at selling a VIX put spread, short put spread on the VIX, assuming that we get a little bit of a rise in implied volatility. Now, we could also go long a call spread as well, but then we get back into that whole meta. Is implied volatility rising? Is it rising on the VIX? Because anyway, you get the idea here, hopefully. So what we're going to do is we're going to look at a relatively short-term time frame. I'm actually going to go out to the 5 expiration here, 20 days out into the future. These are a little bit expensive, but not hugely so, because we're going to kind of get into the middle of and towards the end of the earnings season there. And so we're going to kind of be in that range where maybe we see a rise in implied volatility, which would help, but we're also looking for some fairly elevated implied volatility right now because of earnings season, and we want that possibility of an exogenous move to cause the VIX to rise. So here's what we're going to look at doing. And we're going to start by looking at, and again, I've got volume and open interest on here, and this is going to be a consideration, right? Volume and open interest. So what we might do is, and these are not going to be hugely liquid options. We might even come a little bit shorter here and see if we've got a little bit better volume and open interest, which we do, to be fair, in the 29 July. So let's actually come back to the 29 July. These are a little bit more liquid than, and a little bit tighter bid-ask spreads. The problem is we don't get a lot of premium here for selling a put spread. In fact, we don't get very much at all. So we might be forced simply to go long a put or long a call and just suffer through that, or go long call spread. These aren't hugely expensive index options. So because those aren't liquid, let me go back to the 20 days to go, the 5 AUG expiration. These are fairly liquid here. So you know what I'm going to do is I'm going to actually look at buying, in this particular case, a long call vertical spread. So I've changed my perspective here because there's just not premium to be had in selling a put spread down here to take advantage of that. We could sell an in the money put spread in this particular case, but we've got to have some movement there. Now, that being said, that might be okay, but selling it in the money put spread, again, the important thing to remember is these are European style, so we're not going to get an early assignment. But maybe the mechanics works a little bit easier if we look at buying a put spread or a call spread here and expecting some directional price movement. So I'm going to look at, we're kind of sitting right about the 1585 handle on VIX. So I'm going to look at buying the 15 strike call, which assumes upward movement in the VIX, right? And then to find that, maybe bring that down a little bit, because if I were to leave it right here, now I've got that theoretically unlimited upside movement here, and I've got a net cost of $335 per contract, but maybe we can do a little bit better than that, because if I take a look at where this is, where this might run into that scenario, if we go back to the chart of the VIX, I've got a resistance level up there at about 17, theoretic kind of resistance, because it doesn't trade quite that way. But I've got a typical average area right there about 16 or 17, or excuse me, about the 17 or 18 handle. And then I've got another one up here at about the 20 handle. Now that's starting to get a little bit extreme. So maybe if we go right in the middle of that, we'll go to the 19 handle. And I'm going to say if we see a rise in volatility, the other thing is I'm going to look at my left hand or right hand side here, and I see the expected move is about $2.93. So I'm going to call it 2.92 points, in other words. So if we're going to see what that is, let's just round it up to 3. 15, 16, 17, 18, 1884, that's going to be about 19. So I'm going to look for a move maybe in the VIX from where it is now up to about 19. So if we're already starting to buy the 15, and then we could look at selling the 19 call, still has some open interest there. It's not huge, but the bid-ask spread is relatively reasonable. It's 26 cents. So we're going to look at selling the 19. So now we've got a 15.19, $4 wide, long call vertical on the VIX, for a net debit of $1.94. So what we want to have happen here, we want to have the VIX rise to 19 or above through this spread. So we've got about 20 days to go, right? And so what we're looking for then again is that directional price movement. Now, this is a risk-defined trade. The risk in this trade is just the same as if we were putting on a long vertical spread on an equity. The risk that we have in this trade is what we're paying for it, $1.94 times 100 shares, or 100 units if you want to think about it that way, because these aren't necessarily shares of underlying stocks, of an underlying stock. So this is units, right? So max potential gain in this trade, 206 versus that max potential loss. It's almost a 1-to-1 relationship here. And if we get that pop in implied volatility and this moves out towards that range, we're going to look at closing this trade down at some point. So I know that the max that I can get for this, the most that this could trade at, the most that this spread could trade at is $4, right? 15 minus 9 or 19 minus 15 is $4. So the biggest the width of this spread could be is that $4. I'm going to put this in our index options group and I'm going to kind of walk through this. And again, remember, this is my this is my cost of the trade, the buck 94, making sure that this is what I want to do. I'm going to go ahead and I'm going to click on send. We'll fire that order off and we'll see if we get it. So we got it for a buck 94. Now, what we could do to kind of automate this trade, if we wanted to, is come back to that monitor tab and we could say, look, in my index options group, I've got this VIX trade. I want to see this trade because I bought it to begin with. I want it to get more expensive. I want this to get more expensive. I know that the most that it can trade at is that $4. So I'm going to say, you know what? If this trades at, so I'm going to right click and I'm going to create a closing order and I'm going to look at selling this at a limit price, make it good till canceled. I'm going to sell this at a limit price. And I want to make sure that these are to close and to close. Whoops, not to open, to close. I want to sell this at a limit price of, because I know the width that it can trade at, the most that it can trade at, it's going to be $4. If this trades at $3.50 or better, it's done the majority of the work that it can do for me. So I'm going to get out of the trade. And I'm going to click on confirm and send. And I'm going to look at getting out of that trade if it gets to that point. All right, I'm going to go ahead and I'm going to click on send and fire that order off. And now we've got that exit order in place. I'm not going to put a stop loss on a vertical spread. And we've talked about that for multiple reasons why we don't think about putting a stop loss on a vertical spread, because of that width of the bid-ask spread. Intraday volatility can kick that trade out, and then it goes on to do exactly what you wanted it to do. Right? Remember that spreads don't guarantee an exact price at which they're going to fill as well. So let's do this. That's our VIX spread here at the moment, taking advantage of that possible rise in implied volatility. Now, obviously, we're going to be fighting a little bit of time decay, but we've got some volatility sensitivity too, because it's a volatility instrument. All right, now let's go back over to the charts. And let's take a look at, actually, let's go back here to the monitor tab, because the next thing I want to do is kind of wrapping into the strategy that we've been talking about for a long time in this index options webcast. And that is our 14 days to go until expiration, 7 days to go until expiration, short vertical spread. So I have to put this on. I've been continuing to do this on an ongoing basis, even though I haven't been teaching the class. So last week I put on this trade right here, the 72.10, 71.90 short put spread on the SPX. And I sold it for $1.90. It's now currently trading for 17 cents. We're 7 days to go until expiration. Two things. One, we've captured the majority of the time decay that we can in this trade. Two, implied volatility has gone down a little bit, so that's worked in our favor. And three, I'm not willing to still hold the risk of this trade, which is $20 minus $1.90. Right? 20 minus $1.90. I'm not willing to hold that for an extra 15 cents or $15 if we were to convert that into a per unit basis, right? It's just not worth the squeeze in this particular case to try to hang on and eke out that last little 15 bucks out of this trade when it's done the majority of the work that it can do for me. So I'm going to close it down. That's the reason we're closing it down at 7, because it's done what it can do for the most part. Could it go higher? Yeah, but the most that we could squeeze out of this is 15 cents. So I'm going to right click and I'm going to create a closing order. We're going to buy that back. I'm willing to sacrifice that 15 cents to close this out, eliminate that potential obligation, and we're just going to say, hey, cool, it worked for us in this particular case. Once again, we got it for 15 cents. Again, paper trading is almost always going to fill at that algorithmically designed or derived midpoint. Your mileage may vary in your live trading account. So always a good idea to maybe try to work that order a little bit. Work it inside that bid-ask spread just a little bit here. All right, so let's do this. let's now go to our charts, and I'm going to change my chart here really quickly to my index grid, my index options grid. By the way, this is linked in the description of this webcast. This grid chart that I have that has the left-hand side, the 1 year, 1 day chart, and then the right-hand side, the 3 month, 1 day chart, but with the probability analysis or the probability of expiring cone here. I'm going to take a look at the trade tab here for our SPX options. I see that the 29th of July is our 14 days to go until expiration time frame. So I'm going to take this vertical line, I'm going to right click, and I'm going to just activate it, and I'm going to push it out to the 29th of July, and I'm going to drop that line back in place. That's just a vertical line that I've put on the chart using the time level tool in the drawing tools. And now I'm just going to draw a hash mark there where those two cross. 73.50 is where those two are crossing. 73.50 is where my hash mark is. And you can see that as implied volatilities come back in, that range has shrunk a little bit. Right? That range in which we're selling this has shrunk a little bit. So I'm going to go over here to the trade tab. 73.50 is our crossover between our time and our probability of expiring cone, which is 1 standard deviation. And I'm going to go to my 14 days to go until expiration, 29 July options. I'm going to have to add some strike prices here. I'm going to go out to 120 strikes because I've got to go to the 73.50. I don't have to add quite as many as I used to. And I'm going to look at selling. So let me make this not volume and open interest. We're going to make this delta theta vega. The 73.50 is the one that we're selling. It's about the 14-cent delta. So a little bit smaller delta here, a little bit lower probability of being in the money at expiration, which is exactly what we want it to be, right? So I'm going to go ahead and I'm going to click on 73.50. We're going to click on the bid price, and we're going to sell the 73.50. We're going to bring in 15.80. Then we're going to make this 20 points wide. We're going to buy the 73.30 to define our risk in this trade. So we're defining the risk in the trade by buying the 73.30, selling the 73.50. That's where we want the price to go, is above 73.50 through expiration, or at least through the 7 days. And we're going to sell that for $1.95. I'm going to try to get a little bit more than that if we can. Sitting at $1.95, implied volatility starting to rise a little bit. Something's moving. So I'm going to go ahead and I'm going to click on confirm and send. I'm going to read through this order, and I'm going to see that the order brings me in a max theoretical gain of $175 against that risk of $1,825. You think, wow, that's a little bit skewed. But remember, this is a very highly probable trade. Doesn't guarantee that it's not going to lose, because we've taken some max loss scenarios in this particular trade. But where it loses is if the SPX moves at or below 73.30 at expiration, 14 days from now. We're going to put this in our index options weekly group. And the idea is small gain, small gain, small gain continuously, consistently, week after week after week after week. Now, the only reason that we're doing this on Wednesday is because this class is taught on Wednesday. There's nothing magic about Wednesday when it comes to this. You could have done it on a Monday, a Tuesday, a Thursday, a Wednesday, a Friday. Doesn't matter. All right, so we're going to go ahead and we're going to click on send. We're going to fire that order off. We got it for $1.80. Right, there we go. Got it for $1.80. Okay, so what we've put together now is, again, that 14.7 trade. Now, I'm using S&P 500, the SPX. I know that Connie has experimented with doing this using XSP and other index options as well. Liquidity becomes one of the main reasons why oftentimes we stick with, in this particular case, the SPX versus some of those others. XSP is gaining liquidity, but it certainly does not have the same amount of trading volume that SPX does, which from an institutional perspective is probably one of the most liquid instruments out there in terms of its options trading. If we were to change this layout to volume and open interest, even though you got individual variations, right? The 7350 has, volume, relatively low volume today, but it's got a fair amount of open interest here. If you start to look closer to the at the money position, both on the call and the put side, is where you're going to start to see some of that increasing volume and open interest on this product. So it's an important consideration. But when we're talking about building a two-legged spread like this, right? Selling the 73, in this case, selling 73.50, buying the 73.30, you've got two bid-ask spreads that you've got to cross in order to get to that trade, right? In order to get to that price. So something to pay attention to. XSP, if we were to take a look at XSP in the same context, XSP, which is the mini S&P index options, and we were to go out to the 29 July expiration, you can see that its open interest is starting to grow. So we would be at the 735. It's actually got a little bit, I'm surprised. It's got a little bit more open interest here. You know what? For the fun of it, I'm going to do the same thing in the XSP, and I'll throw this out here. So we're going to do the 735. We're going to sell the 735, same thing. All right, 7350 on the big index, 735 on the small index. So we're going to sell the 735 and we're going to buy the 732, which gives us our 20 wide, or, in this particular case, the equivalent, right? And we're getting 26 cents credit against, if we were to look at this, 26 cents credit against 274. So roughly kind of an equivalent amount. I just want to see how this performs relative to the big index. And it should perform the same way once again. But again, growing liquidity here in XSP. So that is a consideration in terms of placing these trades, in terms of primarily exiting these trades. So I'm going to put this in our index options weekly group as well, just so that we can track both of those products. And we'll fire that order off as well. So we got that for 27 cents. It doesn't seem like a lot, but again, we're talking about 7 days. We're talking about 1 week's time frame. So that, once again, if there's more open interest, could allow for increasing the number of contracts in that particular case. So here's what we've got. We've got our short vertical spread in the big index, right? And that is right here, the 73.50, 73.30. And we've got our 14.7 spread in the 735, 732. Actually, I went one wider, didn't I? I should have been at the 733. Huh. Let's do that again. Just for the sake of it. Just to stay consistent. I'm going to buy that one back. And we'll just get out of it. And this is the nice thing about using a paper trading account, is I can just close that trade down. Now, I could have adjusted those positions, but I don't want to in this particular case. So I'm going to go to the 735. We're going to sell the 735. See, that's my math, guys. And I'm going to go to the 733. There we go. Now we're getting a little bit less credit because we're paying a little bit more for that 733, but I wanted to be consistent with. So $18 credit here, roughly the equivalent. If you keep the scales the same as that $1.80 credit that we got on the big one, click on confirm and send, read through this. Loss is a little bit larger here in this particular case, but I want to be consistent with these two. We're going to go ahead and we're going to sell this one, just kind of make that. So we got 18 cents. Now, it doesn't seem like a lot, once again, like I said, but this is where, if there's open interest, allows for ramping up the number of contracts, potentially. Ramping up the number of contracts, however, means that your max theoretical loss also increases, so that is something to pay attention to in this type of scenario. All right. So really kind of interesting stuff. Let's pop back over here to our monitor tab. And let's take a look at our index options, our VIX option at the moment. And our VIX spread that we bought in this particular case for $1.94 is now trading at a buck 98. It started to widen out a little bit, not very much, but that has started to move in that particular direction, the direction that we want it to go. Volatility rising just a little bit, kind of that spread widening out. So we're going to watch that over the next little while here, over the next 20 days. We've already got our exit order in place to take that off if it trades at $3.50 or more. That limit order that's in place in that order. Now, some cool stuff. Let's pop back over here really quickly. And if you want to find a little bit more information about index options or about VIX or about volatility, just come over here to the Trader Talks webcast page and type in the letter VIX, V-I-X. So you've got James Boyd talking about it. You've got me talking about it. You've got me trading it a couple of times, not only in this particular case. The volatility of volatility is a conversation that we had. Low VIX index options, one time that we did that was last summer about the same time. I think we did a very similar type of trade example there as well. So you've got some resources. Just click on that subscribe button when you do that. By the way, you can follow me. You can follow Cameron on X. I'm at Ben Watson CS. Cameron is at Cameron May CS. If you're going to be in the Chicagoland area this weekend, we're going to be in Schaumburg at the Renaissance Schaumburg doing our technical analysis and option strategies workshop. Then we're going to be in Dallas doing our market drive event. Then we're going to be in Orlando doing another technical analysis and option strategies workshop. Then we're going to be in New York talking about advanced options for a couple of days. So we'd love to have you come to any one of those events. They're at no cost to you. Just click on Learn More to register. We'd love to see you there with us as well. So, yeah, Rodney, that might be something that Connie uses, the market forecast tool. I've talked about it before as well. I've got a couple of short videos on it and a couple of webcasts, but the market forecast tool is certainly something that you could use in this discussion as well. A way to look at the market. All right, guys, my thanks to Cameron May for helping out. My thanks to Connie. Hope that Connie feels better a little bit, hopefully very soon here. And my thanks to our great production staff and reviewers. Have a great day, everybody. We'll see you in Schaumburg on Friday. Take care. Bye-bye.